There's a new $6,000 deduction for anyone 65 years or older. $12,000 if you're married and you both qualify. But here's the part almost nobody explains on screen. It starts shrinking the moment your income crosses $75,000 if you're single, $150,000 if you're married, and it's completely gone by $175,000 if you're single or $250,000 if you're married, $250,000. For those of you new here, welcome. My name is Chris. I'm a CPA in Texas. I've been practicing for 30 plus years, and I do this every day. So I'm going to show you exactly where you land, dollar by dollar on screen. Here's the answer up front. If your income is under $75,000 single or $150,000 married, you get the whole thing. $6,000 per qualifying spouse. Above that, it doesn't disappear all at once. It phases out gradually, losing 6 cents of deduction for every dollar that you're over that threshold amount. By $175,000 and $250,000, single and married, whether one of you is 65 or both of you, it's zero. So those are the upper phase out limits. That $250,000 number surprises people. It's the same ceiling either way because the 6% reduction runs against each spouse's own $6,000 separately. What this deduction actually is, quick context for anyone just joining. This isn't the old additional standard deduction for being over 65. That one still exists also, but separately. $2,050 more for a single filer, $1,650 per spouse if you're married. For 2026, we're talking about. This is a brand new second deduction on top of that created by the One Big Beautiful Bill Act. And it only runs for 4 years, 2025 through 2028. And here's the detail, even some preparers get wrong. You don't have to take the standard deduction to get it. Itemizers qualify too. So, let's talk about qualifications. Who qualifies? 3 tests, and you need all 3. 1, you or your spouse must be 65, December 31st of that year. 2, valid Social Security number. 3, your income has to be under the phase-out ceiling. That's just what we covered. One more wrinkle, most interpretations of the law cut out married filing separately entirely. If that's your filing status, don't assume you get any of this without checking with your advisor first. So let's talk about the phase-out formula. Let's put the actual formula on screen because 6% phase-out means nothing until you see it work. Take your adjusted gross income, subtract the threshold. Remember that threshold, $75,000 if you're single, $150,000 if you're married, and multiply what's left by 6%. That's how much comes off of your deduction. So subtract that, whatever that is, from the $6,000, and that's what's left. That's what you actually get. Run it twice for a married couple, where both of you were 65 or older. One for each spouse's $6,000, and that's the reduction in what's left. So let's look at a case study. Let's just make it real. Starting with easy case. We'll say Grace is 68, single, retired, Social Security, small pension, some interest income. Her modified adjusted gross incomes comes to $58,000. That's under the $75,000 threshold, so there's no phase out. Nothing to calculate at all. Grace claims the full $6,000 on top of her standard deduction and her age 65 add-on. And it works the same way married. Grace's neighbors, Sam and Rita, both 68, have a combined adjusted gross income of $140,000. So what is that? It's under the $150,000 threshold. Full deduction. They get the full $12,000, no reduction, no math required. So let's look at the phase out. What happens? Now, in the case that you actually need a formula, Let's use Walter. He's 66. He's single, still consulting a few hours a week, Social Security and IRA withdrawals. His modified adjusted gross income is $115,000. That's 40 grand over the $75,000 threshold. Multiply that 40,000 by 6%, and the reduction's $2,400. So you take the 6,000 minus the 2,400, and his actual deduction now is 3,600. Not zero, not the full amount. He sits sort of right in the middle. That's the number that goes on his tax return. But let's look at another. A married couple, both 65, Hank and Dorothy. Let's say they're 67, retired, pension income, required minimum distributions, and some investment income, bringing their combined adjusted gross income to $210,000. That's $60,000 over the $150,000 that they're allowed. So run the formula. 60,000 times 6% is 3,600, knocked off of each spouse's $6,000, leaving $2,400 apiece. Okay, add Hank and Dorothy's together, and their total senior deduction is $4,800, down from the full $12,000, but still real money, still a deduction. So who loses it completely? Here's where we go to zero. A single filer, $180,000 of adjusted gross income is $105,000 over that threshold. 6% of that, $6,300. I think you see where I'm going with this, which wipes out the full $6,000 deduction and then some. So their deduction is actually zero. Now, for a married couple, the same thing happens at $250,000 of modified adjusted gross income. That ceiling is the same, whether just one of you is 65 or both of you are, because each spouse's own $6,000 hits zero at exactly the same $100,000 over the threshold point. And you can see that $100,000 times 6%, $6,000. That applies to each spouse. So the trap, one big year can cost you the deduction. And it's what catches people off guard. It's exactly the kind of thing that shows up in my office in January. Nope, after the fact, where no planning can be done. This phase out runs off modified adjusted gross income for the year, which means a single big Roth conversion or cashing in a large capital gain can shove you over the threshold and cost you thousands in deductions you'd otherwise have kept. Even if your normal income is nowhere near $75,000 or $150,000 before you convert a big chunk of an IRA or sell highly appreciated assets, you're counting on this deduction. Run the math first. Sequencing, it matters, and typically there's planning opportunity. Now, let's see where this fits. If you watched the first video on this series, you already met part of this deduction. It's one of the three pieces that built the $47,500 tax-free floor for married couples, both 65 or older, in 2026. The $32,200 standard deduction, the $3,300 age 65 add-on, and the $12,000 of this exact senior deduction. Everything we covered today is really just a closer look at that third piece and why it's not automatically $12,000 for every couple. If you want to know exactly where your own modified adjusted gross income lands, whether you're getting a full deduction, a partial one, or none of it, talk to your advisor. Post a question down in the comments. I'll be happy to help you if I can. And as always, I hope you got real value from this, and I appreciate you watching. Thank you.